Ray Dalio says the risk to U.S. Treasuries is even greater than what Moody's is saying. Okay, Dalio, of course, Bridgewater Associates, a major figure in the financial world. Why don't you first explain to us what Moody's did and then give us your take on Dalio's take?
So Moody's downgraded U.S. debt from AAA to AA1, right? So we are no longer this AAA credit. Now, this is the third downgrade the U.S. debt has got, but the most prominent is this first happened 14 years ago.
That's going to hit me in the wallet as a taxpayer. Why?
Because it means yields go up. So
you got to pay more when you pay it off.
Right. So it means
higher
we're a
interest.
riskier bet. So people are still going to buy U.S. Treasury, but they're going to demand a higher interest payment to buy that debt. There's more risk involved in buying it.
This comes up periodically locally when Omaha's AAA rating is threatened or drops. Same thing.
And it did. We do not have AAA
the city
rating
bond
here.
is going to cost
and
more.
And the streetcar's not going to get you anywhere closer. But anyway,
I didn't want to get you onto that track. All right.
All right.
Anyway.
So we have 300, and this is by my count, so I don't have a source for this, so my compliance hours are going to yell at me here, but it's approximately $321 trillion in debt between sovereign governments and corporations in the world today. Interest rates have moved up over the last 2 years, Chip, by about 200 basis points, 2 full percentage points. So what's 2% of 300, Chip?
Well, let's see. 10% would be 30. So 2%, what's that going to be? About 6. Okay.
$6 trillion in additional interest expense around the globe right now. Do you know that that's over $750 for every man, woman, and child on the planet? On the planet. $6 trillion.
It's hard to
we
wrap
only have
your
8
brain
billion
around
people.
that. Yeah.
Yes, that's just additional. Every man, woman, child, additional interest every year now has to be paid at $750. Where is that money coming from?
Well, the problem is it's just going to be generated, apparently.
So to pay the bill, you will start running the printing press, right? We've seen that last 15 years.
Whether you do it physically or electronically.
The Euro, the EU, here, and that is what Ray Dalio is talking about.
Okay.
Right?
All right.
He's talking about, listen, earnings are, hurt, and higher rates make earnings harder for companies because capital costs more. But the only way we can really pay our way, if Congress doesn't get serious and start cutting spending, the only way to do this is they're going to fire at the printing press again. It's just a matter of when. Politically, they don't want to say they're doing it. But then what does that create? Monster inflation again, right?
So it's a double whammy. Not only do I have to, on paper, pay off at a higher rate,
but you're printing more.
But the dollars in my pocket
are going to be
my
worth
return.
less.
The dollars I'm paid on my return for a bond or anything else are worth less because of the inflation. Oh, this is giving me a headache.
Yeah, so we have to get serious now, and that's where I got excited about Doge. And they do have to seems to be somewhere between 200 and 300 billion in savings they have officially found. But that's nothing at the rate we're spending, right? And here we are about to pass a budget bill with another 2.8 trillion deficit spending, and we have to get serious. And so this is for the new mayor here of Omaha. You need to keep your budget for Pillin here on the state level and our legislators. You got to keep your budget. Your school boards. And guess what's about to happen? Your valuations are going up all over town right now, right, on this real estate. And so they're getting this big cash influx thing. Oh, our budget's fine. No, it's not, because houses are going to go back. Anyway, we're going to get too far off the tangent. This is a real problem. Now, Ray Dalio has a brand new book that's being released, I think, June 6th. I was privy to get an early copy of it. It's called How Countries Go Broke. And it's fantastic. And we'll probably dive into this a little bit more going up limited for time today. But this is a massive, massive problem. And that's where the cost of capital goes up. So we've seen interest rates skyrocket over 20 basis points. The 30-year, as we're sitting in today, the U.S. Treasury 30-year Chip is over 5% today. That means mortgage rates are higher. So mortgages are well over 7%, on their way to 8%, which is going to really harm our housing market. And I've got neighbors that have their houses for sale, and I kind of laugh when I walk by them. I walk my dog every day, and I'm like, there's no way you're getting the price you've listed at. The gentleman bought this house. I've got a neighbor that moved in just over a year and a half ago, and he's increased his price by about $200,000 from what he purchased. I'm like, that's just not going to fly. And I don't know why the real estate agent professional even dared list it at that price. He's probably 70, 80 grand over what he will get. But anyway, you're going to see some changes economically in the housing market, et cetera, from this debt.
David, let's squeeze this in. You mentioned that when Moody's knocks down your rating, that has costs in terms of what you got to pay in interest rates and maybe inflation when you generate currency to pay more. You sent the team a chart about the U.S. debt downgrade. You said it's not a nothing burger. Why?
Well, so there were many pundits saying, hey, this is a nothing burger. It's no big deal. So what you have is that next morning I showed 2% interest, a 2 percentage point increase of interest rates, not only here, but Germany, France, the United Kingdom, Spain, everywhere across the globe is paying more because we're the central reserve currency of the world, right? And that's not going away anytime soon, folks. But we are. So if it costs more for our debt, it costs more for the countries that invest in our debt. And all these countries are having to pay more now. So that's what I was saying. It's a $6 trillion problem interest, as I mentioned earlier in the show, that all these countries are now having to pay higher yields, higher rates, and then inflation's ticked up. So the UK this week just reported 3.5% inflation, well above their expectations, which means they're going to have to raise the rates even more to fight inflation, right? And that means the debt spiral is back out of control. So we need austerity measures. We need the Congress people to get serious. And again, nobody's trying to cut Medicare or Medicaid for anybody that's on it, but we must make reforms to these programs. We must get serious. If you're under the age of 50, I'm sorry, Social Security needs to be pushed back 1, 2, or 3 years based on how old you are. You didn't start working till later in life. That's proven statistically. So, and you're going to live about 6 years longer than your boomer counterparts. So why not have you start drawing 1, 2, or 3 years later? We can solve these problems with logic, but again, the political rhetoric of, oh, he's stealing from you, or grandma off the cliff, etc.
Yeah.
So we need people that are willing to be term limited to go to do the right thing and then just bow out of Congress. By the way, would you like to run again, Chip? I hear there might be an opening in District 2.
Look at the clock. We've got to go. That will definitely do it for this week, folks.